Ton of uncertainty out there. And when I listened to you guys recently, it's raise more cash and reduce exposure. Is that the idea you're trying to get behind at the moment, Mark?
Yes, Jonathan. I think what we're looking at is peak growth. The U.S. economy is coming off in 2018, 3% real growth. We're slowing down to 2.25 now. And if you look at the global economy, it's really stalled. You look at Europe, it's basically growing at 1%. China has slowed significantly. There's a lot of uncertainty with the U.S.-China trade. And if you look at inflation, we can't even get to our inflation target here in the U.S., let alone Europe and Japan. So the Fed can be on pause right now and really wait for the data. And I think that's what really is driving the markets right now is we're waiting for the U.S.-China trade, the resolution there, and the Fed can wait and see what happens with data going forward.
So, Mark, I'm really interested to know from your perspective what is happening with the Chinese policy response and just why it doesn't seem to be biting into the Chinese economy. Do you see some problems with the transmission mechanism that the Chinese need to address to make it work?
Well, I think the big issue is that, like we saw in the United States 12 years ago, we had elevated housing prices. So if you look at China today, these housing prices are at pretty elevated levels. It's very hard to inflate an asset price that's already what you could call overvalued. And if you look at consumers, you can give them the loans, but that doesn't necessarily mean they're going to go out and buy a house if they feel like house prices aren't going to go up. So it's called pushing on a string. You have increased money supply, but it doesn't translate as much into growth because the velocity is not there. And so I think that's what you're dealing with is you're going to see less ability to stimulate in terms of China, both on fiscal as well as on monetary policy.
So far, Mark, people are getting behind the idea that the economy will stabilize, that the Chinese, the United States, maybe even the Europeans over the next several months will do more to support this economy. The market's moving before the data validates the trade. Mark, are you ultimately saying that's a mistake?
So I think that's a good point, Jonathan. I think if you look at earnings growth, the market's price for 10% earnings growth this year, 10% next year. China is clearly stimulating. You saw that in the most recent monthly credit data. They're cutting taxes, but again, I don't think you're going to see the multiplier effect. And so the big picture here is that we're running increasing deficits. We've gone in the United States from 2.5 deficits to now 4.5 and growing. That sugar rush is going to come off. And so you're going to see, I think, these earnings estimates have to come down as the global economy decelerates.
So, Mark, what's been interesting for me, and I'm sure for you and others as well, is that cross-asset vol has come in so much that it's actually encouraged risk. And what I'm facing right now is just trying to ask the question, what is the catalyst for volatility to pick up again and therefore discourage risk-taking? Mark, do you see a catalyst on the horizon?
Well, I think what's driving the market is you've got a lot of optimism around the U.S.-China, some type of resolution. And I think both President Xi and Trump have signaled that they want a deal. Number two, you've had a massive tilt in terms of global central banks shifting more dovish. You've seen a recovery in credit, and that has led the equity markets. Also, you've seen a bounce in energy prices. The problem is that this relationship with the U.S. and China is not fundamentally going to change. There's going to be continued friction on intellectual property going forward. This is all occurring at a time when central banks are going to be withdrawing from markets over time.
Yeah.
And the ability to stimulate going forward is not going to be there in terms of fiscal, particularly in the U.S. when you're running 4.5%, 5% deficits. So I think that's what's going to be troubling for the markets going forward.
So, Mark, typically when people say the kind of things that you're saying, they usually follow it up by saying we're going up in quality. And I hear that from you today, but I want to understand more specifically what going up in quality actually means for you at the moment, Mark. What does it mean?
So what it means is basically bringing down your equity beta, owning more cash than normal, owning more high-quality bonds. So it would be tilting the portfolio towards high-quality treasuries, agencies, investment-grade corporate bonds, owning less high yield, owning less levered companies. This has been a situation where the rising tide has lifted all boats. Part of what's also driving the market is you've got $9.1 trillion of negative yielding government bonds out there in the world. And that's increased significantly even in the last 3 to 4 months. So it's technicals, it's a lack of issuance. That's what's driving the market, and the fundamentals are clearly slowing in terms of growth. So that's why we do like upgrading quality. We think the markets are set for more volatility ahead.
So, Mark, what's interesting from my perspective as well, just looking at what you're long at the moment, and we have it up on the screen, energy, the global consumer, real estate, global banks. Just looking at that, and I know it's much more selective and idiosyncratic than that looks on the screen, but what that looks like to me is you're not exactly stripping cyclicality out of the portfolio, are you?
No, and we don't think we're going to have a recession this year. We're calling for growth in the U.S. of 2 to 2.25 this year. This is an expansion which continues, and the reason is that there's no inflation. And so with inflation contained, the Fed can take the foot off the brake, and you're going to have this dovish tilt. So I think the expansion can continue, but that does not necessarily translate into rising equity prices. What's priced in, again, is pretty robust earnings growth. So I think the headwinds are simply of the fact that the market is priced in a lot of good news right now. And by the way, bonds actually look pretty decent right now relative to equities. You can still get 3, 4, 5% on high-quality bonds with a third the volatility of equities. So this is a good time for investors to de-risk, particularly out of U.S. equities, into more bonds right now.